Hey, do you think taking loan is always bad? Most of us believe so. But did you know that rich people often use debt as a tool to grow their wealth and legally avoid taxes? Today we'll explore how the wealthy use debt to their advantages. But before that, let's understand the types of debt. There are two kinds of debt: good debt and bad debt. Good debt is when you borrow money to make more money. For example, let's say you take a loan to buy a car or a house, not for personal use but to rent it out. If you earn monthly rental income from it, there's passive income. So, this is considered good debt. On the other hand, bad debt is when you borrow money to spend on personal items. For instance, if you take a loan to buy a car just for personal use or to purchase an expensive phone. This thing might bring short-term happiness, but they don't help grow your bank account. In fact, you have to cover their costs from your other income sources. So, this type of loan is bad debt. Now, let's come back to the rich. Wealthy people usually use very little of their own money when starting or growing a business. This reduces their risk of losing personal wealth and at the same time gives them opportunities to legally avoid paying high taxes. Primarily, the rich use good debt in two main ways to increase their wealth. Let's dive in. Number 1. Buy, borrow, die strategy. However, this strategy follows multiple steps. Step number 1. Buy. Meet Mr. Roy, a wealthy investor. Years ago, Mr. Roy bought $100,000 worth of Tesla stock, and now it's worth $1 million. He doesn't sell the stock because if he sells, he'll owe capital gains tax on the $900,000 profit. Remember, capital gains tax is a tax on the profit you earn when you sell an asset for more than you paid for it. Step number 2. Borrow. Now, if Mr. Roy needs money to invest somewhere like real estate, instead of selling the stock, Mr. Roy goes to bank and says, "Hey, I have $1 million in Tesla stock. Can I borrow $300,000 at 5% interest per year against it?" The bank agrees, since he has valuable collateral. Now Mr. Roy has $300,000 in cash, tax-free, because loans are not taxed. He has a monthly repayment of $2,650 for installment and interest to the bank. He buys a rental property for $300,000. Now he renovates it and rents it out. Let's say it gives him $3,400 per month in rent. So, every month his tenant indirectly pays the bank loan. And he earns $775 without spending a single penny from his pocket. And if the price of the house rises, he makes more profit by the rent. Over the years, the rent paid by the tenant covers the entire $300,000 loan. Meaning Mr. Roy ends up owning the property without using any of his cash or selling his stocks. Meanwhile, the Tesla stock he used as collateral is still growing in value. Step 3. Die. Before going to step 3, let's understand the concept of step up in basis. Basis is basically what you originally paid for an asset. For Mr. Roy, his basis in Tesla stock is $100,000 because that's what he paid. When a person dies, the US tax code resets the basis of their assets to the current market value at the time of death. And this is called step up in basis. Now, come back to step 3. So, when Mr. Roy dies and the Tesla stock is worth $2 million, his children inherit it with a new stepped-up basis of $2 million, not the original $100,000. Because of the step-up in basis, the tax history is wiped clean. His children can sell the stock at $2 million and pay no tax on the $1.9 million gain. Now, what happens when Mr. Roy dies? Let's say the children sell the Tesla stock immediately after inheriting it for $2 million. Here, sell price $2 million, stepped up basis $2 million also. Capital gain 0. So, no capital gains tax is owed. This is why the buy borrow die strategy is so powerful, because regular working people pay tax on every paycheck, but the ultra rich can legally avoid most taxes using asset growth and smart borrowing. Number 2, leveraged buyouts or LBOs. A leveraged buyout is when someone buys a company using mostly borrowed money and then uses the company's own profit or asset to pay back the loan. To explain it, let's take Mr. Roy as an example. Let's say Mr. Roy wants to buy a small and profitable company. The company makes $1 million per year in profit. The owners agree to sell it for $10 million. However, Mr. Roy doesn't have the $10 million in cash. Instead, he uses the strategy called leveraged buyout. Mr. Roy puts in $2 million of his own money and borrows the remaining $8 million from a bank. Now he has the full $10 million needed to buy the company. Even though most of the money is borrowed, Mr. Roy becomes the full owner of the company. After buying the company, Mr. Roy uses the company's own profit, the $1 million it earns every year, to pay back the $8 million loan over time. He doesn't have to use his personal money to repay the loan. The business pays for itself. In a few years, once the loan is fully paid off, Mr. Roy owns a successful company outright, one that may now be worth even more than $10 million. And remember, he only invested $2 million of his own money to begin with. This is how he used other people's money, or the bank's money, to buy and own a big business. And there's the power of a leveraged buyout. But using debt is not a game or something to take lightly. It comes with significant risks. If the stock market crashes, or property values drop, or a business fails to generate enough profit, investors can lose their invested money and obviously struggle to repay the bank loans. That's why it's crucial to fully understand the type of debt you are taking on. If not, business owners are at high risk of making serious mistakes. To manage this, the wealthy often diversify their investments and make sure they have a clear understanding of the nature and terms of the debt they are using. Let's take a real-life example of Elon Musk, one of the most well-known billionaires, and how he used debt strategically to build wealth and avoid taxes. Elon Musk is worth hundreds of billions of dollars, but he rarely sells his Tesla or SpaceX shares to access cash. Why? Because selling stocks would mean he has to pay capital gains tax on the profit. Instead, Musk follows a smart strategy used by many ultra-wealthy individuals. He borrows money using his Tesla shares as collateral. Collateral means a guarantee for the bank, since he isn't selling anything. So there is no taxable events and no capital gains tax. Here's how it works. Let's say Elon Musk owns Tesla shares worth $10 billion. He goes to a bank and uses those shares as collateral to borrow $1 million in cash. He then uses his borrowed money to fund new ventures or buy assets or even cover personal expenses. Since it's a loan, he pays interest on the borrowed money. But he doesn't owe any tax because loans are not considered income by the IRS. Later, the value of Tesla stock might increase, or he might pay the loan back gradually. But during that time, he can use the money to invest in more companies or start projects or buy real estate, all of which can grow his wealth even more. So, as I've seen, debt isn't always an enemy. In fact, when used wisely, it can be a powerful tool for building wealth, just like the rich do. Whether it's investing in real estate or leveraging stocks or buying entire business. The key is understanding the difference between good debt and bad debt. Thanks for watching, and I'll see you in the next one. If you found this video helpful, don't forget to give it a thumbs up and subscribe to the channel.